Welcome to Zen and the Art of Real Estate Investing. What if you could learn from experienced real estate investors, find out what got them to where they are now, get insight into their daily habits, and take these insights to inspire your own growth? Each week, Jonathan Green shares an in-depth look at the mindful approach to real estate investing. Jonathan is a lifelong real estate investor, advisor, and coach, as well as the founder and team leader of Streamlined Properties. Whether you're looking to start from scratch, get to the next level, or just for a straightforward and honest approach to real estate investing, Jonathan seeks to provide a free mentorship program you can take with you anywhere. Now, here's Jonathan.
Welcome back to another episode of Zen and the Art of Real Estate Investing. Got a great show for you today with our third return guest. My guest is Drew Breneman of Breneman Capital, and we're going to talk about the current state of multifamily syndications. Now, that's going to talk about syndications as a whole, but also do a deep dive on renting versus buying and all of the things that go into being a multifamily operator. Let's get to Drew. This is episode 212 of Zen and the Art of Real Estate Investing with my guest, Drew Breneman. Drew is the founder and CEO of Breneman Capital. He is also our second-time guest. You can find him before on episode 40, Creating a Blueprint for Real Estate Success. That was back in April of 2023. Drew, welcome back.
Yeah, thanks, Jonathan. Thanks for having me on. Appreciate it.
Yeah, it's always good to talk to you. And full disclosure for the viewers, I am invested in 2 syndications with Breneman Capital, and it all started with our previous podcast. So that's an interesting story, but getting you back on, I wanted to first go over the state of syndications right now, because the last time we have 172 episodes in between your last and now, which is kind of crazy to think of. But a lot's changed in the syndication world, and I've watched it from what you guys are doing. So what do you think has changed in the last couple of years that's relevant for the listeners to know?
Yeah, well, quite a few things. I think just just kind of what's going on in the real estate markets obviously changed a lot. Where you went from, from 2020 to late 2022, the Sun Belt had just such a massive explosion in rent growth, population growth, job growth, and prices and investors followed all that. And so you were, at that point, everyone, including myself, they were looking at the Sun Belt going, what should our next deal be? What can we do? And where all this rapid growth is. And, all that, around the time we recorded our episode was basically shut off like a light switch in those markets, where there's still a lot of population and job growth in all those, Sun Belt cities. But what happened is just a lot of new apartment supply, and just talking about apartments only, because that's all I invest in.
Yeah.
A lot of new apartment supply just finally started hitting in 2023, right as the rate of change in population growth and job growth was slowing. It's still, Austin still has, let's say Texas, has the highest, population and job growth in the country. The problem with Austin is, to pick on a particular city.
Well, you also live there now, right?
Yeah. Yeah. I live here, but I'm not, haven't even looked at any real estate deals because it has the highest amount of new supply. So, apartments are pretty simple. It's supply and demand, and you have a lot of demand in Austin, but they've found a way, at least for the foreseeable future, to provide more supply than there even is demand for. And so rents have dropped. Occupancies are in the, high 80s on average in Austin. And I think in some submarkets way worse than that. And so that's been the biggest change, where before people were buying deals at, 3 caps and just aggressive numbers, and Austin and all over the Sun Belt, and obtaining insane rent growth. And then all of a sudden it flipped, where rents are flat to down. And now, without the growth there, people aren't willing to pay 3 caps anymore.
Yeah. And just for people who are getting familiar with syndications, a big adjustment just across the board. If you buy 200 units in Austin and then your rent expectation goes down 100 per unit, that could take your valuation down $2 million.
Yeah. And I think even a lot of these deals, when you look at them, they are to be anywhere near what's projected for the returns. They need to deliver on their growth assumptions. And a lot of these deals that were happening, 2022, 2023, at least early in 2023, people were thinking they'd get 5% rent growth per year, plus move the rents up to market. And then what happened is rents dropped. So, they might be 20% off of pro forma rents on what they thought they would hit. And, in a deal where they'll be lucky just to get their money back.
Yeah, from a consumer's point of view, don't you think that right now to be a renter in Austin would be really smart versus buying? And that's kind of part of the dynamic. Like, there is rent going down, but are people going to take the opportunity to get a really swank rental where they need to fill them, if they're already active?
No, that's true. And actually, Austin has it's one of the places that it's like comparing the home prices to rent. Personally, I've not been in a place in my whole life where it's been more out of balance than Austin is, where renting is quite affordable compared to buying here.
Yeah.
Like downtown condos are $700,000-800,000 for like a 2-bed, and you can rent something, much more, in the $3,000 range, for that. So that's what it's like in the suburbs. I rent to myself here in Austin. So I'm renting for an amount that probably would be, like the guy's property taxes plus like a little bit, like enough where if you bought it with a mortgage, you would be making no money. I think he bought it, a while ago. So I think I know his situation because I've talked to him all the time. He doesn't want to sell it for less than the peak price that it would have been worth a couple years ago. He views that as losing money. So he wants tough. He just wants to rent. But yeah, I think he has like a 2-3% interest loan from, on yesterday's price, before the, 2020 boom. So yeah, I'm putting my money where my mouth is on that one. So then it's a lot cheaper to rent here in Austin, but obviously that comes with some trade-offs where there's a lot of, benefits to owning too, long term. And then, there's no customization of this place going on in my household. So
can't touch a thing. Yeah. But it's an interesting dynamic because I've been talking about this a lot and I want to get your take on it. I really feel there's going to be a lot of conscious renters. I mean, you're an adult with a family and making conscious rental decision, whereas other people are kind of told in the beginning, hey, you have to be an owner. And I think I probably thought like that, but I'm starting to look at it differently for my kids. My kids are both adults, yours are all younger, but the landscape's a little bit different. So I'm starting to think maybe people are going to go into rentals by choice and then use their money to invest in properties elsewhere or invest in syndications or turnkey, kind of things that are a little bit more accessible instead of flipping a house. What do you think about that based on your experience?
Yeah, I think people are doing that because when people always ask me about owning or renting, I always you got to look at how long you're going to be in the property, number one, because in a lot of these places, and I grew up in the Midwest my whole life. I just moved to Texas last year, so I'm used to, I'm from Milwaukee and then lived in Chicago, so I'm not used to prices going up so rapidly. So This has been my same answer for a long time, but it's been, you need to be in the place long enough where you're going to cover all the transaction costs. All the costs to purchase it and then all the costs to sell, which are significant. So the idea, like when I was graduating college, 2007, that was everyone wanted to buy back then just because prices were going up so rapidly. But kind of since that recession, I think that mindset shifted to people are a lot more realistic now.
Yeah.
Where you go, okay, will I be in this long enough to cover my costs? Am I saving money by owning, or what does that look like? Because on the home ownership front, I mean, everyone views rent as like it's 100% of a waste, right? Like it's just you're throwing money.
I used to think like that
down the drain. But property taxes, insurance, maintenance, you don't get that money back when you own. So it's not as clear as like, oh, I pay this much in rent is a total waste, because then as an owner you have costs that you're not getting anything for, your loan interest, your property taxes, etc. So I think people are realizing that. And then, if you're disciplined, the thing is, I think what's nice about home ownership is beyond just the personal flexibility and choice and like stability is that it's a forced savings account.
Yeah.
So you're building equity by paying your loan down and the building eventually going up. And so like for a lot of people, if they just rented, they're just going to spend the difference. So, if you're able to actually invest that, let's say you're renting for less than it costs to own, and you invest that entire difference, I don't think it makes a big difference whether you're renting or owning financially. I think, for families and stuff, like the stability of knowing that's like your house, your room, etc. For kids,
you can't get kicked out. You're not. Yeah. But it's interesting though. I think if you look at what people have as disposable income and how they want to do it, they can still become an owner. They just may own a different type of asset. They may end up where you started in the Midwest and say, hey, let me get something there. Maybe I will move there someday, but right now I need to be in a metropolitan and I can get way more for my money and live in like a really nice apartment where if I tried to buy this, I would be paying twice on a mortgage payment. It's an interesting time in real estate. And this also plays into what you guys do for multifamily, because as you're looking for deals, obviously you're looking for rent growth. And we've seen that rent growth wasn't as excessive as people thought. It stopped in some of the areas.
Yeah. Yeah. And I think actually, I bet this whole dynamic is pretty pronounced where you live, because it's so expensive to buy anything in New Jersey, New York, that people who even have, especially if you're in Manhattan, you have a couple 100,000 saved up, you could buy a few turnkeys or invest a lot in a syndication, but that doesn't get you anywhere for a down payment on a condo in New York. So then there's people that, they're still on their way to saving up for a home in these high cost markets that then want to invest in something. They can get into real estate that way.
Yeah.
So
it's interesting though how it's changed. How has it changed your guys' overlook when you're looking at markets and new deals coming in? Because obviously deal flow is a little bit different. It's still out there. Your connections, of course, as we've talked about before, get you to a lot of deals before anyone else sees them. But what's been the difference for you guys when you're overlooking at it now, knowing that, hey, look, every market has a potential downside possibility?
Yeah. And so, since I was on last week, we bought 4 deals total, and then 3 of them were just completely off market. And then with 2 of them being just from a group we already bought property from before, which was one of the ones you invested in. And then the other one that was not in the market, we just bought through like a management company relationship where they introduced us to the owner, the one in Madison. And so, the main thing we did though around the time where I was on last was just really looking at the numbers and going, okay, what makes sense? And this is still going on, where from a valuation standpoint, you have all of the most exciting markets, let's say in the Sun Belt, your Phoenix, Dallas, Austin, Nashville, all of Florida, those trade at lower cap rates, and so do the coastal markets than the Midwest. But right now, the highest rent growth in the country is all in the Midwest. Highest rent growth, highest occupancy. Just going back to the whole supply and demand thing, where the demand isn't as strong, in let's say Chicago as it would be in Dallas, but they're building, a tiny fraction of the same amount of new units. In Chicago right now, there's only 2 buildings over 50 units under construction in the entire city.
Wow.
And the reason is, interest rates, construction costs, but also they enacted a 20% affordable housing requirement. So if you're going to build a new property, a new multifamily deal, 20% of the units need to be at affordable rents, which is, for rounded numbers, it's not how it's calculated. It's a third to half the normal rental amount. So then that makes your deal not financially feasible.
Right.
So you have, all these neighborhoods in Chicago on the north side that are growing still very rapidly. I think it's a common misconception that obviously Illinois, the population is not growing, but within it is having some population loss in some parts, but other parts are growing fast. Like the north side of Chicago, those neighborhoods in downtown, that grew at a similar rate to Denver from 2010 to 2020. So, and no one thinks Denver is not growing. And so you have the growth like Denver, but no supply. And then and so we looked at that. And then also, like I had mentioned before, I'm from Milwaukee, and then I also went to college in Madison. And those markets are also at the top of the charts for rent growth, high occupancy. Madison right now, as we said, is number 2 for highest occupancy in the country, number 4 for trailing 1-year rent growth, number 6 for least new supply across all markets. And then Chicago is basically at the top of every list when it's for just the big markets, the largest markets. So we saw that and go, okay, you have the best fundamentals right now, and you have higher cap rates there than all these other markets. And so we just went, let's just go back to what we were doing, and from, basically 2005 to, 2021, when we finally started looking at the Sun Belt, we just said, all right, let's just focus back on the Midwest and just do what we've always been doing. And it's gone really well. I know everybody, the deal you invested in, has been really happy with it. We had
if you think of the Chicago one, the first one that I invested in, now that's even in my head, just from what you said, more valuable, because new builds are going to be tougher. They're not going to do that because they don't want to have, 20% or 30% of the units at a lower rent. You'd have to rent the ones, make even more luxury up top, and then you're out of balance in there.
Yeah, no, that's true. And even, all the deals that's definitely right, where the price point people are building, the cost to build now compared to where we bought it is significantly higher.
Yeah.
We were buying it from someone who built that building in 2020. So they had, a different cost basis by a lot than what they'd have today. But, that developer has other deals that, obviously we'll look at. And I know for a fact they need more money
Yeah.
to transact, and the rents aren't any higher because, obviously the renter doesn't care what costs you to build. They're looking at, just what the market will dictate.
Yeah.
And so, that, and on top of that, every deal that we buy, like I'm looking for a few things. Like I want it to be, a newer, nicer, well-located property. So we have every zip code in the whole country ranked and scored. And also just, anecdotally in these markets, I've lived in all of them. So I already know, what's going on there. And then we're looking for deals that make sense, on today's prices. So we're not paying an aggressive number because we think we could renovate it or up the rents. We're buying it at, an attractive cap rate, attractive price per unit, all the metrics people look at, attractive price per foot for what's there today.
Yeah.
And then the deal needs to have some upside. So like the first one you invested in is exactly that. We bought it at a cap rate where we have positive leverage day one. We bought it going in at plus or minus a 6 cap, borrowed at 5.5% interest only for 5 years.
Yeah.
So we started out with 8% cash on cash from the get-go. In the 6%, I'm saying that's after our taxes were to adjust post-purchase. So we started out with more cash flow because I hadn't adjusted yet. But we bought it in large part because we knew the rents were below market. And so we've raised the rents already on average 8% on that building this year across all renewals and new leases. And on our new leases on the 2 beds, we've raised rents 15%. So just how we drew it up with no CapEx or anything, we just walked in there and raised the rents.
What was the occupant transition then? Were most people, I'm trying to think back to the data that I've seen, did most people stay and just kind of acknowledge, what, we were paying under market, so now we're just paying market?
So I used to be the one having all those conversations. And then when that was the case, a lot of people they would say, I knew I was getting a good deal. I'll just, stay. This is still like a fair price. I looked around.
Yeah. So
I assume that's the case, but we did not have our turnover at that building was just right in line with a normal amount,
right,
where, in these
people going to buy or moving. Yeah.
Yeah. On these sort of like city assets, like a normal turnover rate is 50%. Like if you look at some of the REITs out there, they have this data too. Their average turnover is about in the low 50s.
Yeah.
And
that's way more than I thought it would be.
Yeah. In the suburbs, people are more sticky, they stay longer. But in these, city deals, people, typically they're there for 1 or 2 years. But we were just right in line with this normal turnover. So, if someone, maybe they weren't happy with the increase, but they were, moving out anyways, and so, we didn't have, and two, we will work with people. Like if they want to stay, I'd say, and they were way below market, we're negotiable, just being realistic with, if they're going to, with the idea that we'll eventually get this to market, so to speak, in terms of the pricing.
Yeah. And also I think of that as the same as I'm, talking to people who are buying a 2 or 3 family and they have an existing tenant. I'm like, if you can get them up close to market and they don't have to move and they're a good tenant, why not just keep them? That's a win for now. You don't have to do anything to the unit.
Yeah. No leasing costs, no turnover costs, no vacancy. They're paying the rent. So there's a lot of benefits to doing that. So we'll work with them within reason. But so then that's that deal is just going just how we drew it up. Actually, and our property taxes came in lower than when we underwrote too. So then, hitting our rents and beating on expenses right now.
What across all of your syndications, what's the average unit count? Because if I'm looking at the Chicago one and the Madison, those are both, I guess, quote lower. They're like in the 50s, right? Do you have other ones that are larger? What do you think? What's about the average for you guys?
No, I was starting to pull some of that up. I think they're smaller unit counts, these city deals. Like, they, because I have just some 6 units that I bought, the 50 unit, that's a $18 million deal. So the price per door is, significant when people are paying $3,000 some dollars a month and there's, low operating expenses. Yeah. But no, I think the average, unit count, I mean, the range is 6 units to 96 units. And then I'd say the average is probably, in the high 20s. Yeah. In terms of unit count.
That's nice, though. That's a little bit different. I mean, I think it's a different type of product that you're looking at compared to other syndicators where, 200 units is a lot of management, a lot of upkeep. Yeah, there's a lot of scale there too. But so your focus, if you're always under 100, you probably don't have any. Well, I guess in the city you could have in-house management, but those are different cost basis when you're over 150, 200 units.
Yeah. Yeah. So all those deals that are in Chicago that, it's between 6 and 72 units on those, we don't have any on-site staff. We manage them all remotely from our office in the West Loop. And then, so yeah, we have 3 people that work full-time managing, 300 units. And it's actually we have all the tasks divvied up more. Like typically, let's say you would have a property manager works at a property. They're doing accounting, they're doing collections, they're doing leasing, right? They're doing everything. Where we have it actually all divvied up and separated. One gal just only paying bills and doing accounting. Another person we have just hourly who checks over and closes out the books. Then we have, someone who only does leasing, someone who only does property management. It's all separate. And when I say property management, is basically just tenant relations and maintenance requests.
Yeah.
So, and then that same person does renewals. So it's all broken up. So that way they're just way more efficient.
Yeah. In terms of build dates, I mean, when I looked at, the Chicago one, I was like, ooh, 2020, this is good. Is the build date really important to you based on what your guys' principle of investing is?
It is. And I think, it's important, but also understanding these buildings. I've been, historically flexible on the build date. It feel like it was a gut rehab. So I think a lot of people have just a hard and fast rule. I don't want to buy anything before a certain date because, they were like told that or so, and there are less buyers, like especially in some of these places. Like if you go and you're buying something in those Sunbelt markets that I was talking about, like if you're buying something that's in the 70s, was constructed in the 70s, there's less buyers than as you go down through the decades. The buyer pools drop off. But I think what's important to us, is that all the big ticket items are up to the modern standards. So,
foundation,
copper,
plumbing, electric. I mean, the things that are going to be oops, I didn't realize that was going to be, $500,000.
Yeah. So the deals that I have never bought, and there are a lot of them, especially in Chicago, are these ones where let's say the building's 100 years old. It's been rehabbed just, let's say at random over the last 100 years, but it still has the original, let's say sewers, and the electric was last updated, in like the 50s. Yeah. But then on top of all that, they did an entire cosmetic rehab, quartz counters, granite counters, new cabinets, new bathrooms. And I'm going, man, whoever buys this is going to have a lot of problems to deal with. Like nothing.
Closed it all up too.
Yeah, I know. They added it all, all new laundry sometimes on the old drains and just, nothing, and not everything's permitted. And you can realize those deals I never have been a buyer of because I look at it and go like they're getting the like full gut rehab rents basically because, the tenants don't know what was done with electric or why that would be important down the line. They're just looking at it and assuming everything, should work. And so then I see those deals and they sell like they were a gut rehab and they weren't. And then someone's going to have just a bee's nest of problems. So
yeah, I mean, that's really good advice for LPs when they're looking too, because I mean, when you look at it, you can see that, ask those questions and see, well, I don't want to get hit with a capital call later because those are the ones that can look a really pretty pro forma PDF, because like you said, the rents are hot. And they're probably low capping what the CapEx is for now to make it look good. And that's part of, what we're all trying to find, which syndications are real and which aren't, which we talked a lot on our prior episode. But yeah, that's one that you can ask. And I think I've learned, of course, over the years that now, you should be able to ask questions, of the GP and get a quick answer, right? I mean, for you guys on your end, if I ask you a question, you're going to have the answer. You're going to get me to someone who does. And I think that's what LPs need to look out for when they're looking to get into this, as an investor.
Yeah. If your GP doesn't know their deal, then that's not a good sign if they don't know those answers.
Yeah.
But I think a lot of people, they're partnering up. One thing that on the GP side that I think you touched on that I personally think is like a misconception but it's other people, I think, talking their book, so to speak.
Yeah.
So they'll say, there's all these efficiencies on these bigger deals. The numbers are better, et cetera, et cetera. Like you make more money on bigger deals. I actually think the opposite is true. I think on the 200 unit deals, you're competing with these bigger groups that have lower cost of capital. Your returns are lower, I think. And then because you're bidding against institutional equity, and then the expenses at the property, those are a cost that's already baked into the valuation of the property. So the fact that you're saving money, let's say in maintenance, because you have an on-site person on payroll versus calling out for someone every time, that's already baked into the value of the building. So I don't think that I don't think you're getting any efficiencies like from a value standpoint. Maybe, sure, you buy more toilets in bulk and can store them on site. Yeah, you're saving money on your toilet, but but that was already baked into the numbers. Yeah. So I think but I think a lot of people, because what they do is they'll join one of these, mastermind groups or something, and they'll 4 or 5, 10 people, whatever it is, will partner together, and then that'll be the GP team and buy a deal. And then that's one talking point they all go to because they're buying a 200 unit, that it's better. But as someone who's bought, from 2 units on up and just kind of started at a duplex, like I don't think that's the case. I think the most inefficiency in the whole market is what you want to look for. And I think these deals that are $5 to $30 million is where the market's the least efficient. It's a big size for an individual buyer, too small for those institutional groups. Yeah. And then the expenses are what they are in the pro forma. So I don't really think the scale really helps the deal at all.
Yeah, and I think that, that amount of units, like you said, it's trending right between institutional. There's that market that institutional buyers don't want, especially if it's not upgraded. They don't want that. They're not doing value add. So it has to be somebody local who has the price in and isn't getting a market price. Like those 10 people you said who go in together and create one, they're paying market price because they all together maybe don't have the contacts to be able to get that. You've said, and we've talked about before, the longer you're in the business, people bring you deals and you get to say yes or no to a lot of them. And they bring you deals that are good with good debt, and you have the banking relationships, which is very important to me. When I learned really when I looked at the first deal, I looked at the debt and I was like, ooh, this is like, because rates were like 8 then, and we were at like, 5.5. Yeah, and I'm looking at it saying this can't, and with the 5-year, which is great because I can look at what the plan is and see, okay, yeah, this makes sense to me. But yeah, I think that's where a lot of people are missing. I'm really focused on the debt because I think I understand a lot more watching the deals now, and that's obviously something that you're looking for also. You can take over some existing debt, but you also have banking relationships that can help you when you've been in the business for so long.
Yeah, I think, for anybody who's buying multifamily that's 5 units on up, the best, cost of capital is going to be Freddie and Fannie. Yeah. And they have 2 different programs you can use at each one: a small balance program for loans that are under 5 million or 7.5 million, depending on the market. And then their conventional programs for over those amounts. And like the deal, the loan I had on that at 5.5%, like, we got preferred pricing because we've done so many loans, but that discount was maybe, 20 basis points, so 0.2%. And then we did a rate buy down. So we paid 2 points to have the rate lowered, but so that we were getting a better rate. But if someone else still could qualify for that loan, but maybe it had the, preferred status, so to speak, their rate still would have been in the 5s. Like it would have. So it's just really more speaks to like, this is one of the reasons why I like these kind of deals. The agencies get aggressive on them. It's a 100% occupied building. They love to lend on it. And then, whereas if you're buying a value add rehab deal, you're going to a debt fund. It's, SOFR plus a spread. You're all in today, including your interest rate cap. You're paying like 8% interest a year. And then, by the way, the deal unlevered makes way less than 8. So you're negative leverage the whole time. Yeah. So that's why focusing on the debt, I think is smart. And for us, like, we only, buy deals that are positive leverage day one, meaning that, your cap rate you're buying it is higher than the interest rate you're borrowing at. So you'd have positive cash flow.
Yeah, that's a really important point, and one I don't know that we've talked about a lot all through these episodes, because that's more attractive to the lender. it's a better deal for the lender. It's more solid.
Yeah. And so they're lending where they are sizing these loans where they have a 20 or 25% cushion. So, a 120, 125 debt cover if people use that calc. But that's, where they already have a buffer built in. And that's the only way those agencies lend. So it is more attractive. And then, and also Chase Bank is a great option for stabilized if, they're the most competitive non-agency lender for multifamily, but they're not in every market. They're only in like a dozen.
Hey, it's Jonathan. I hope you're enjoying this episode with Drew, his second appearance on the podcast. And if you remember at the beginning, I told you, full disclosure, I'm invested in 2 multifamily syndications with Breneman Capital. If you want to hop aboard that train, which a couple friends of mine have as well, just do an intro call by going to Breneman.com, and you'll talk to Drew or someone on his team, and you'll get an overview of what they do. I love working with them because, as you can tell from this episode and Drew's prior episode, it's very straightforward. And whether you invest with Drew or any other syndicator, you want to make sure that you're vetting the operator as much as possible. And that's where you're going to really get your first feel for, is this going to be a fit? Let's get back to Drew. As you watch everything change, what do you think is going to happen for the next 2 years? I mean, you've adjusted how the deals that you're looking for and where you're looking, but what do you see? I know you, and I know you're a data nerd like me. So what do you think's coming in the next 2 years, and how are you adjusting what you guys want to do, as a company that's looking to acquire multifamily in an odd market that we all hope is going to level out at some point, but hopefully level out, in your favor for better deals?
Yeah. And I think, really for what we're looking for, it's very simple, where we're trying to find, like I was saying, these deals that cash flow day one and then have some rental upside. Yeah. And so I'm just laser focused on that. And I'm not really spending a lot of time, prognosticating what's going to happen. I'm happy to answer the question though, but in terms of for our strategy, it almost in a way it will matter. Obviously, if the market starts ripping up, our deals will do better. But the way we underwrote these deals was just almost as if nothing changes. We raise the rents to what they should be today, and then rents grow 2.5% to 3% a year, as well as expenses from there. And then that's it. And then we sell it at, a reasonable cap rate, and there's not really anything changes. I think, for the main thing that I've been surprised with, I'd say, is a lot, some of the other sponsors that are doing a lot of these Sunbelt deals, a lot of them, nothing's changed. They're still doing the same floating rate debt, value add, aggressive deals. And, I did one of those. I saw how difficult it is and how much risk was involved, where you have no real cash flow while you're renovating and you're trying to get it to a certain point in a market that ended up being declining. So those deals are, to me, extremely risky. And, I sort of almost don't understand why make that bet anymore, so to speak, when you could just buy something nice, hold it for 10 years, cash flows already, make it cash flow more. And I know this is very oversimplified and you can lose money in deals, but it's like you look at that, let's say we'll buy something in cash flows today on low rents, we're going to own it for 10 years. It's just really hard to lose money on that. Yeah. And then when the market does start going up more rapidly, you'll still benefit from that. So you really don't need to worry about, with our strategy, timing the market at all or anything. So, but to answer your question, I guess I think that the odd part about the market now is most everyone is holding on to their deals. So there's not a lot of stuff for sale, which then that keeps the pricing, actually relatively strong, where cap rates went up a lot, but all deals are still trading at neutral or negative leverage in all the markets. And so they're not attractive when you look at okay, this is where this sold. And it'd be wow, that'd be you got to put 40% down and you'll have 3% cash on cash starting out. That is probably right now your average apartment deal. That is literally the metric for a stabilized apartment building. Yeah. So then it's just, you look at that and go, that doesn't feel like this distressed market where there's deals everywhere. And I don't know if we ever will get to that point, because a lot of, so many people, I know there's a lot of talk about floating rate debt and all this stuff and short-term loans, but all the lending is still done by these agency lenders, 5-10 year fixed rate money. Yeah. So multifamily, there's just the way the debt is set up, there's going to be, I think, less distress than people think. the distress that will be there, it'll be all on the value add floating rate 3-year bridge loans, where the ownership group doesn't want to add the necessary money to keep the deal going.
Yeah, and they miscalculated or misadjusted what they thought was going to happen.
Well, yeah, or let's say you bought a deal, and you borrowed 70% loan to cost, and then the value dropped 30%. So you have no equity in it now. You could choose to just try to carry it or walk away, or say, hey, let's refinance to a permanent loan. But to do that, you need to basically put down an entire another down payment and get that to an appropriate leverage point. And so, it's just the only deals that'll be available are the ones where people go, let's just walk away. Yeah. So it's been very few.
What's your average hold time for properties? I mean, because you buy in a specific buy box that are all pretty similar, that they're already kind of ready to go. What's the average cycle time?
Yeah. So far I've done 43 deals, and on the 12 that I've sold, the average is 5.5 years. And then the average for what we, project for a deal is 7 to 10 years. Those are usually the hold periods we're projecting. Because again, you just go back and look, and we have a calc actually in our graph in our company overview where we went back and calculated, this is trailing appreciation by year with the different hold periods. Mm-hmm. And on a 10-year hold, the annual appreciation across that time period has not been negative since if you bought something in the late 80s. So you would have had to go through the RTC, and then when you sold in the 90s, you would have had negative appreciation. Doesn't include any cash flow, so can't tell if you would have made money on those deals or not. But so for the last, 30 something years, you would have not had any deal, on average. Obviously you could cherry pick deals, I'm sure, in certain places where, that didn't make money in 10 years. But then when you do that same calc on 3-year holds and 5-year holds, there's lots of time periods where that happened. So, it's 3-year holds going into this year are not going to be positive. And same thing in 2008 and 9 and 12 and 11, and all those ending years were bad for anything 3 to 5 years. So that's part of the reason. And then we like to, I like to take advantage, like I do all these, and, people reach out, we do investor calls with new investors, and most everyone, they say they want to diversify, they want cash flow, and they want to build, they don't want to pay a lot in taxes. Yeah. But then what they do is they go out and they invest in, a 3-year hold renovation deal, essentially the same thing as like a house flip, but they don't visualize it that way. And there's nothing wrong with flipping, but you need to realize that's about as risky of a deal as you could invest in. The thing is, since they're not the ones doing it day to day, they view it as like, oh, this is the same amount of risk as buying just like a stabilized deal, right? And it's like a totally different thing.
Yeah. I don't think everybody even realizes that they're not going to get paid right away also, because it's just kind of maybe a question they don't ask. If you're on a major value add, you're getting paid once that's complete.
Well, what some people do is they'll over raise for their deal. So let's say you're going to invest $100,000, and there's no cash flow the first 2 years. Yeah. They'll raise $116,000, let's say, just for numbers here, and then pay out $8,000 a year to the, and have 8% cash on cash during the renovation. And actually the syndicators who did that, they've had the best staying power in this downturn, because then they just pivoted to say, we're going to hold that for carrying. So it but we don't do that. We just pay out what the property makes, and then, they already cash flow right away. But yeah, I think what I like about the long-term hold is if people want the tax benefits, buying a deal for 3 years. So, okay, year one, great. I take a great big loss on my tax return with the bonus depreciation, all this. And then 2 years later, you sell it. Well, you're paying capital gains and depreciation recapture right away. So like that wasn't that big of a timing benefit. And then same thing, then you pay a lot of transaction costs and then more taxes to sell. And then you wait for the next deal, you invest in another one. Whereas with a 10-year hold, let's say you take that loss in year one for tax purposes, you have cash flow, and then you wait 10 years to pay the tax like that on the depreciation recapture or capital gain. That makes a lot of sense to me. And so what I always advocate to people, instead of doing, let's say, over a 10-year period, three-year, value add deals in a row where you're paying all these taxes and taking all this risk, do one 10-year hold, take advantage, have it actually cash flow, take advantage of the tax benefits. And then in, somewhere between year 3 to year 5, do a cash out refinance. So then you take out a larger loan, pay off the existing, and then the remaining funds get distributed to the investors or owners. And then buy a second deal with that refi money. Now you have two deals paying you, let's say from year 5 to year 10. When you add up what you make after tax across those two comparisons, it's pretty similar across those two. The 3-year back to back to back versus the 10-year and the 5-year combined.
Almost no risk.
With way different risk profiles. Exactly.
Yeah, and it's interesting because most people are looking to syndications to limit their risk and diversify their portfolio, but they don't understand the differential in risks between different types of syndications. They all, I guess if you can hang on, and you're looking at it, you're okay, but there's inherently more risk in value add and declining rental markets and things like that, especially in, where you move to. I mean, Austin's like the picture city for this, of course it's going to be fine. Austin's a great place to live, but there was a lot of inventory built and there's still a lot of standing inventory that's in process, right?
Yeah. And I mean, and you're totally right. And I think a lot of these deals that get set up where it's a 3-year floating rate loan, we're going to take the property from, essentially point A to point B value wise. And if you fall behind that, you don't hit your rents, you don't hit your rehab costs or timeline, you get so off track on those deals. Yeah, I don't think the average LP really realizes that. And I think, because a common thing that I talk to people about is that, and just pointing that out, where I know I had a call, unfortunately, with a guy he had done really well buying just duplexes and just regular rentals long term, and he invested in his first syndication, and it was a major rehab on an old deal in the hood in Phoenix, and within 2 years the thing was already in foreclosure. And I said, like, I don't want to, this might be rough to point out, but it's essentially you invested in like a big house flip, like I said before, and you would have, from everything you told me so far, you would have never done that on your own. You want cash flow, you want to preserve your money. Like, that's literally what he's telling me. And then the deal you go in is essentially this big flip. And so that's, I think something, people really need to keep in mind.
Yeah. Awesome, man. Well, I'm really excited to get you back on the show. I was checking in with you all the time. Obviously, we talk a lot, but it's nice to have you back after all this time and then really survey the market and see what's happened. So I appreciate you spending another little hour with me. And as always, I'm sure we'll stay in touch. The best place for people to get in touch with you is BrenemanCapital.com, right?
It's actually just Breneman.com.
Oh, so, yeah.
Yep. And then
that's why I went to look it up before and I was like, why isn't this working?
Yeah, that's I know. I can't get a hold of the guy who has that. Yeah. I've been trying, but it was hard enough to get Breneman.com from this guy who got it in the 80s.
Yeah.
But Breneman.com/downloads or just Breneman.com is the best place to go. But what I was going to mention, just given everything that we talked about would be helpful for people, is I made 2 courses that are just 5 email courses. One is geared towards brand new people that literally have, if you had not heard of a syndication before. Actually, my landlord here, he was getting a pretty significant bonus at work and was talking about buying another house to me.
Yeah.
He was wondering why I had this camera in my office. And I was like, I have this, this real estate thing. Anyways, he had never heard of syndication. So I was like, let me make something as if you literally, like, email 1 is if you have no idea what it is. And by email 3, everyone's probably learning something.
Yeah.
And then I made another one more of that's the new investor one. And then I made this masterclass one, I named it, but that's more advanced. That's going to tell you, in my opinion, the 5 steps on how to invest passively and in the right order to do them in. Yeah. And I guess because the main thing I think people do is they just start looking at deals right away. And in the 5 steps, that's the last step. Yeah. You need to figure out a lot more before you should even bother looking at deals. You need to know your goals. You need to vet the sponsors first. You need to understand the fees and risks and everything. So it's all that's covered.
And that's on Breneman.com?
Yeah, Breneman.com. And then that's on the downloads page or resources. I forgot what it's called at this point, but
they'll find it.
You'll find it on there. So
awesome, man. Well, I appreciate you swinging back for being our second time guest. I really appreciate it.
Yeah, thanks for having me on. I appreciate being here. Thanks.
Yeah, of course. That was Drew Breneman of Breneman Capital. If you want to go back and listen to Drew's first episode, it's episode 40, Creating a Blueprint for Real Estate Success with Drew Breneman. And you can hear how Drew got started with eBay money. So go back and listen to the episode. It was the first time we talked, and I love that episode. Thanks a lot, Drew. Appreciate it.
Yeah, thank you. Yeah, no, I listened to some of that at the start this morning when I was having breakfast. It was funny. We said like, nice to meet you. You know, like, you said nice to meet you in the intro. I was like, nice to meet you too.
Yeah.
So yeah, that was good. But I really liked what we talked about here. And then, that first episode was great in terms of, just talking about just getting started. Cause I think a lot of people overcomplicate it. So I like saying that story where you just had some money, bought a deal.
Yeah. That's how you get started. Yeah. Awesome. All right. Well, that was Drew Breneman of Breneman Capital. I'm Jonathan Green. We'll see you next episode. Thanks for sticking around to the end so you can get that preview of who's coming up on the next episode of Zen and the Art of Real Estate Investing. And it's a good one. If you like short-term rentals, I would hop in on the next episode. My guest is Garrett Brown. You'll find him on Bigger Pockets as the resident STR expert. You can also find him on Instagram at Garrett Brown RE. He's dropping knowledge, reels, and a ton of information. He's the person behind the STR emails that you get from Bigger Pockets. So stay tuned. Next episode for Garrett Brown.